Welcome to The Explainer. Today, we're going to break down a really powerful trading strategy called the continuation entry. It's all about figuring out one thing. How do you safely jump into a market that's already on the move?
I mean, it's a classic trader's dilemma, right? You see a market taking off, but you're thinking, how do I get in now without getting totally burned? Timing is everything. And man, can it be frustrating when you get it wrong?
So, the core idea here is to kind of flip your mindset. Stop trying to predict the market. Instead, the strategy is all about reacting to it. You wait for the market to prove its direction, and then you find a smart, low-risk way to get on board. And that's the whole point, isn't it? To trade with the momentum. The goal of this whole approach is to really increase your odds of success by making sure you're swimming with the current, not trying to fight against it. Okay, so at its heart, this strategy is just a simple, repeatable, three-step process. And you can apply it to pretty much any market scenario you find yourself in. So everything kicks off with what the source calls a trigger event. Just think of this as your reason to start paying close attention. It could be a classic chart pattern, like a double bottom, or it could just be a really strong trend that's already happening. All it does is give you a bias. Are we looking to go up or down? And here's the whole framework. It's beautiful in its simplicity. Step 1, you spot that potential trade with your trigger event. Step 2, you have to be patient and wait for the market to actually prove your idea is right with a breakout. And only then, for step 3, do you zoom in to find that perfect entry point. Think of that 3-step process as your safety check, It keeps you from just jumping into choppy, random water. Instead, it lets you wait for that powerful established current so you can just ride the flow. Patience is absolutely key here. All right, so let's apply this. Let's see how this works in our first big scenario. How to catch a brand new trend right as it's getting started. Right, so the context here is what really matters. When we're talking about a reversal, your step 1 trigger event is some kind of pattern that tells you the old trend might be over, like a double bottom that signals a potential shift from down to up. The goal is to get in right at the beginning of that new move. Now, as part of your trigger event, you'll often see signals just like these long wick candles at really key levels. They're basically a picture of a fight, where buyers or sellers are pushing back hard, giving you a hint that the tide might be turning. So after you get your confirmation in step 2, you move on to finding your entry in step 3. What you do here is zoom into a lower time frame and just wait for the market to take a little pause, to consolidate into maybe a small triangle or a tight little box. The breakout from that smaller pattern, that's your exact signal to get in. But what if a nice, neat little pattern doesn't show up? Well, there's another way. You can look for a specific setup. This is where the price makes a small dip or a pullback to a key technical level. That little pullback is your opportunity to enter the new trend at an even better price. Okay, now what's really cool is that this exact same 3-step logic works perfectly for our second scenario, joining a trend that's already, in full swing. It's like safely hopping onto a moving train. In this case, you're not looking for the trend to change direction at all. You're just acknowledging what's already happening. Your bias is already set by the trend. The whole goal is just to find a low-risk spot to jump on and ride that momentum. And you'll find these high-probability entries often pop up at something called an area of confluence. This is just a spot on the chart where a bunch of things line up all at once, like a trend line, a moving average, and a support level all crossing at the same point. It's like a technical hotspot that makes your entry signal way, way stronger. So to pull this all together, the core process is identical for both scenarios. It doesn't matter if you're catching a reversal or joining a trend. Step 1, figure out your directional bias. Step 2, wait for the market to prove you right. And step 3, find that precise entry using a smaller pattern or setup. Okay, so this all sounds logical, right? But what actually gives this approach a real edge in the market? Why does being patient actually work in your favor?
Well, it really boils down to 3 huge advantages that this patient confirmation first method gives you.
And what's great is how this tackles some of the biggest fears traders have. First, your entry is just more secure. You aren't guessing, you're reacting to confirmation. Second, you avoid so many of those frustrating false breakouts because you're waiting for that second signal. And finally, it gives you a clear plan for adding to a winning trade, a technique called scaling in. So you see, the continuation entry is way more than just a chart setup. It's really a whole mindset. It forces you to shift from trying to predict the future to simply reacting to the present with a clear, repeatable plan.
And that really leaves us with a big question, doesn't it? In a world that's all about moving fast, maybe the most profitable skill in trading isn't just finding the next big move, but having the discipline and patience to wait for the right moment to join it.